There are many business owners out there assuming that the money sitting in their business bank account is protected, and it is, up to a point. What caught a lot of people off guard in 2023 was exactly where that point sits and how much money can be sitting past it without anyone at the bank ever bringing it up. So let me explain how deposit protection actually works, the part almost everyone gets wrong, and what Treasury teams at larger companies do about it, because the solution is genuinely clever and most business owners have never heard of it. Let's start with the number. FDIC insurance covers deposits up to $250,000. If your bank fails, that's what's protected. Everything above it is, in the technical sense, an unsecured claim against a failed institution. You might recover it eventually, you might not recover all of it, and you almost certainly won't have access to it when you need it, which for a business making payroll is its own kind of failure. Now here's the mental model I want you to remember, because it fixes the most common misunderstanding immediately. FDIC insurance is not a blanket laid over your money. It's a container with a fixed size. That distinction matters enormously because a blanket would stretch, a container doesn't. $250,000 fits inside. Everything beyond it sits outside the container, uncovered, and moving it around inside the same bank doesn't help or do anything. Which brings us straight to the mistake. Business owners hear the limit and think, fine, I'll open 3 accounts at my bank and spread the money across them. That does absolutely nothing. The coverage is per depositor, per bank, per ownership category, not per account. So your operating account, your payroll account, and your savings account at the same bank, all held by the same business, share one container. 3 accounts, one $250,000 limit, same exposure as before. The container isn't the account. It's the relationship between one depositor and one bank. Let me put real numbers on it and paint a picture. Say your business holds $1.2 million across accounts at a single bank. Comfortable cash position, nothing exotic. $250,000 of that is insured. The other $950,000 is not. That's not a technicality. In a failure, that's the portion you're waiting on a receiver to sort out while payroll is due Friday. And most business owners holding that balance have never been told because there's no requirement for anyone to tell them. So what do you actually do about it? There are a few real approaches, and they're worth knowing in order. The obvious one is to split the money across multiple banks yourself. $250,000 at 5 different institutions, and you're covered. It works. It's also genuinely painful. 5 relationships, 5 sets of logins, 5 sets of documentation and compliance, and reconciliation across all of it. Most businesses try this once and give up. The second approach is moving cash out of deposits entirely into money market funds or treasury bills. This is common at larger companies, and it's a legitimate strategy, but understand the trade. Those aren't FDIC-insured deposits at all. They're investments with a different risk profile, and they behave differently in a crisis. Not worse, necessarily, but different, and worth understanding before you assume it's the safe option. And then there's the third one, which is what many successful Treasury teams actually use. There are deposit networks, sometimes called reciprocal deposit or deposit placement networks, that solve this automatically. You keep one banking relationship. Your bank participates in a network of hundreds of other banks. When you deposit above the limit, the network distributes your funds across the member banks in increments that each stay under $250,000. And because deposits flow reciprocally between member banks, your own bank keeps an equivalent balance on its books. The result is that a business can hold millions of dollars in fully insured deposits through one relationship with one statement, seeing one account. I want you to notice what that solves. It isn't a bigger container. Nobody raised the limit. It's a lot of containers filled automatically without you managing a single extra relationship. That's the whole trick, and once you see it, it's obvious, which is exactly why it's frustrating that so few business owners are ever told it exists. A few honest caveats, because this isn't free of trade-offs. Not every bank participates in these networks. The rate you earn on those balances may differ from your regular account. And there's paperwork to set it up. None of that is a reason to avoid it, but it does mean the answer isn't automatic. So here's the thing I'd want you to take from this. The businesses that handle this well aren't more sophisticated than you, and they're not better connected. They just asked their banker one question that most business owners never think to ask. How much of our balance is actually insured, and what are the options if it isn't? That question costs you nothing. It takes one email. And the difference between the businesses that ask it and the ones that don't tends to show up at exactly the moment you'd least want to find out.